Howdy there, partner. This is Scott King, mortgage broker here for Pacific West Capital. Making a little quickie video for you folks to help you understand the FHA loans and how they work. I've been in the mortgage industry for about 21 years now. My company, Pacific West Capital, started in 2002, and we've done lots and lots of FHA and conventional loans. Things have changed over the years. Just want to point out a few highlights for you on the FHA. So, yeah, for first-time home buyers, good. If for folks who don't have a whole lot of down payment to put down on the house, you can get in with as little as 2.5% down payment. Actually, here in California, you can do a couple of programs to get you 100% financing if that's what you really need. It has to do with a small second mortgage for 2.5% of the purchase price. And you have to be within certain income limits in order to qualify for that. And I won't get into the details of that right now, but some of the nuts and bolts of the FHA loans it would include the insurance fund. FHA insures the loan. Okay, in the case of default, so lender makes a loan, borrower quits making payments, there's a default, FHA will insure the loan, and so the way they get the insurance money is by collecting mortgage insurance premiums, and there are two types of that. When you buy the property, there is an initial upfront mortgage insurance premium, which is 1.75% of the purchase price. So that is usually that it can be financed on top of the loan, actually, or it can be done by paying in cash, or the lender can pay for it with a credit. Now, what you can do is you can ratchet up the interest rate on your loan and get a yield spread premium, which can pay that 1.75. I've done it for a number of clients. It's helpful when they don't, want to raise the loan amount, or come in with the cash for closing costs. So that's one way to do that. And then there's also the monthly, or the annual insurance premium, which is 0.85% of the loan amount, and that's divided by 12, and that's included in your monthly mortgage payment. So on an FHA loan, impounds are required for taxes, property taxes, insurance, homeowners insurance, that is, default insurance, which is the mortgage insurance, and what did I say? PITI, so property, principal, interest, taxes, insurance, and default insurance. Okay, if you're buying a condominium or townhouse, there's often a homeowners association fee, and that's not impounded usually. Some homeowners associations actually pay the property taxes, so taxes would not be impounded in your monthly payment. There's a few other intricacies like that on an FHA loan. So what else we got here? I think that's about all I wanted to say. Well, FHA loans, most lenders won't touch you if you're below a 580 credit score. Now, I have a few lenders here that'll fund down to a 500 score on an FHA loan. When they do that, your cap, the loan to value, is less, substantially less. You're not going to get in with 2.5% down payment. Normally, the debt to income ratio is also about 43%, as opposed to 50%. Also, most lenders require a desktop underwriting approval. I mean, you need to have your loan application approved through automated underwriting to qualify with the FHA loan. And so, that's about it. If you have any questions for me, just let me know, drop me an email, or give me a call on the toll-free line here. It's 866-625 RATE, which is 7283. And I'll be happy to answer any questions you have. and visit our site for more information as well. Thanks for watching the video. Appreciate it. If you like what you saw, appreciate a thumbs up, and click the little bell, subscribe, and we'll let you know when we have another video coming out. Have a great day. Thanks again. Bye-bye.